Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, Andy Christopher, welcome to Pilot Money Guys, man. We're glad to have you back, and
good to be here.
Glad to have you on the show today.
Yeah, thanks, Charlie. Good to be back with the Pilot Money Guys.
That's right, man. Absolutely, and welcome to everyone, all of our listeners, all our professional pilots that listen, pilots, airline pilots, corporate pilots, fractional pilots, and Andy, some spouses listen too to figure out what the heck's going on in the world of aviation. So we appreciate that. And we hope we can add value to them as well. But we're excited. So we appreciate all of our pilot tribe that can rate and review the podcast for us. Helps us get to more people, Andy, so that we can just get the word and message out. Our mission with the Pilot Money Guys is to just create clarity. You know, there's a lot of confusing topics out there, to educate, provide tangible, sometimes tangible steps to certain things, and sometimes just to educate. Today is going to be more of you and I kind of talking about some things. Our main objective today is just to educate, inform a little bit more on private equity, alternatives to the regular old plain Jane stock market. And is it appropriate? So we've been getting a lot of questions lately like, hey, I've done the stock market. I have a lot of money in the markets, possibly, relatively speaking. And should I be investing in other things, maybe other fancier, schmancier things? What are the things that smart people do? What are the things that rich people do, right? So those are some things that are out there, and those are I'm being a little bit facetious, of course. So, but sometimes that's the impression. So we're going to talk to that today. Am I a poor schmuck because I only invest in the stock market? Maybe that's the title of our episode today, right?
Yeah, I think so. Yeah.
So before we get into that, though, we are going to talk to a couple things, questions from the flight deck. And basically, a couple of those are some of the changes that we are going to just reiterate. One of those is the Roth, or required mandatory Roth catch-up contribution for most all of our airline professional pilot folks, because they're over, I think it's 42,000 is the income. So we're just going to assume that most everybody's over that limit. And especially if you're making catch-up contributions, you probably are, because you're 50 or over. They have to be Roth next year. We're going to talk a little bit about that. You're going to fill us in on the thrift savings plan changes for in-Roth conversions, in-service Roth conversions. I think I said that right, and why that's important. So it is important. So those are the things we're going to cover. We're going to jump into we'll call it the private equity, education piece a little bit after that. But Andy, welcome back, man. Any good stories from life on the boat?
No, yeah. For those who don't know, I was reservist deployed for the last 10 months. No good stories. It's a different world, but happy to be back in this world for sure.
That's right.
Figuring out, why my 4-year-old doesn't listen to me anymore. Like
he doesn't just
what happened.
He doesn't just not listen to you. He doesn't even like you.
He does not like me. Yeah, it was him and mom for the last 9 months, and then I showed up, and he's like, "This is not good.
Strange.
This is not good."
You're like the wheel in all family events.
For sure. Yeah, I think I told you it's, a couple times the last few weeks. It's like, I got to run to the grocery store or something. My wife's like, I'm going to run out real quick. And my 4-year-old's like, Dad can go do it.
Let Dad go.
Yeah.
Man. He needs to leave.
Yeah. Yeah.
Oh, man. It's funny when they're 4. And sometimes they rip your heart out, but they're 4. So you can, deal with it. But sometimes I think when they're teenagers, you're going to do the same thing. And that's going to hurt a little bit more, maybe. I don't know.
Yeah.
We'll see.
Good. Looking forward to it.
Absolutely. Good times, right? I've had teenagers before, and they didn't hate me too much, I don't think. But anyway, so that's good. All right. Well, awesome, Andy. I tried to, just for everybody out there, I tried to get information on where Andy was, what kind of ship he was on, what kind of coordinates he was, at in the weaponry. But I was testing his operational security, and he passed, so he didn't tell us anything. So nothing exciting to report there. All right, but let's jump in. So, me and Kevin, the Professor Gormley, covered the Roth catch-up a little bit. But I think even since then, we've kind of revisited a little bit and talked about, let's reattack this to get a little bit more clarity. And I think, Andy, one of the things that I struggled with in my brain was trying to figure out how to generalize, all of our pilots out there. And I can't, we've got, when they contribute to their 401k, they have money coming back to them in excess And so it kind of negates some of the deductions that you would have gotten. But plainly, we've kind of looked at enough scenarios to go, yeah, you're going to lose a tax deduction because your catch-up contribution is Roth.
That's right. Yep. No, that's exactly right. I mean, it's just previously, right? If you were super catch up or just a regular 7,500, like you were getting a tax deduction on that catch amount, just like you were if you were doing pre-tax deferral on your regular 401k and normal 401k. But that's going to go away. It's going to go Roth. And so I think, Charlie, what we were looking at was like, well, does it matter? Because if you're an airline pilot and you're getting the spill cash, depending on what airline you work for, sometimes it's, for some of the folks, it's going straight to the cash balance plan. But the end result is, right, that spill number is not changing, right? And so if you were getting spill cash this year, and if all things were being equal, next year, it's the same amount of spill cash, whether or not you have that catch up as a Roth or pre-tax. So I think the takeaway, right, for people is like, yeah, to your point, like you're going to pay more in taxes, all things being equal, because that's going into a Roth account.
And the interesting thing is to see how that will look or what that will look like on the 401k websites, because like we mentioned before, some airlines, you select those separately. You select, do I want to do the catch up? And then you select in a different button how much you contribute your regular contribution, not including catch-up. So that'll have to be separated. And I think Southwest right now, those are together, one and the same, but I think they'll have to change that for let people delineate, similar to the other airlines, United, Delta, American, et cetera.
Yeah, absolutely.
Andy, what are some strategies? I mean, we're losing a tax deduction. What are your thoughts on how to mitigate that?
I think strategy one is not change anything. Just put your catch-up in as Roth, right? And so a lot of us, or not us, but a lot of our catch-ups who are you're high earners, right? Because you're 50 and up. Yeah, you're at a high marginal tax bracket, but your hands are tied, right? So it's not an active decision that you get to make whether you defer that or not. So option one is just to keep doing what you're doing, and you get more Roth money. I think we're all in agreement. In retirement, having Roth money is a good thing. Another option maybe is like, hey, I'm just gonna, if you were contributing to Roth in your 401k, not your catch up, obviously, in your 401k, well, maybe you make that all pre-tax because that Roth portion is going to be in the catch up bucket now. So if you were, say you were doing 100% Roth as an example, we were talking about earlier, maybe you do 50% pre-tax, 50% Roth, and now you get the catch up as all Roth, right? So your net amounts, unchanged. That's going into the Roth amount. So maybe that's, I don't know. What do you think about that, Charlie?
Yeah, I think it's a good idea, but I like what you said. Hey, this is really a good thing.
Yeah,
it's something that we love Roth, and most people don't have enough of it, and now kind of forced to do it at certain levels. So we kind of like it, like exercising and eating right.
Yeah.
We're going to be forced to do those things. So I think one of the things, we're not exactly sure this will play out at each different airline, but what normally happens when you select Roth, it's not like at the end of the year all of a sudden you're going to owe a big fat tax bill because I was doing it, now I got to do Roth. What we believe will happen, which is already happening when you select Roth, is that income that tax will be withheld along the way.
That's right.
So if you were to pay really close attention to your paycheck and you flew exactly the same amount each month, you might notice a couple $100, and that's a totally a wag right there. But let's pretend you notice a couple $100 a paycheck that your paycheck was lower by a couple $100. That's what it would look like. Most people are not going to be able to see that because their paycheck varies pretty wildly.
Yeah.
So that's might be what we see there.
Yeah. Yeah. And the other option, kind of comes to mind here, Charlie, right? If you're, in particular, this applies for our Southwest pilots, and you really like the idea of having the same amount of net tax deferral, you could not make a catch up and instead allocate that, say, to the top hat. I think we all know there are downsides to the top hat, right? It's not creditor protected. So, I would talk to your, financial advisor, planner, whoever, before you start going down that path. But that is one way to get the same amount of net tax deferral, is to use that top hat. For those who aren't familiar, that's the non-qualified deferred compensation available to our Southwest pilots.
Yeah, absolutely. And of course, Delta, now Americans rolling out their market-based cash balance plan. So they get that tax deferral. So that's going to help offset that a little bit. If
That's right.
especially those folks at American that decide to use it, they're going to be able to turn that on or off. I think once every 3 years is what we're learning now. And then the United folks, they have the spill cash going into the HRA, which is a tax deferral option as well, which is a great option.
That's right. Yep. Yeah.
Awesome.
We can get into the nitty gritty details on United's, but yeah, there's at some point you'll start spilling until they change that.
Absolutely. Yeah. United's is my favorite because it's the most complicated. So anyway, awesome. So the next thing that is an important rule change is this idea, and you brought this to my attention the other day because I kind of glossed over it, where you can tell the company, this may be a little different, but I'll start here anyway, but you can tell the company, direct the company to make their non-elective contribution NEC into Roth as well, which to me is like a Roth conversion, in-service Roth conversion, which have been around a while. But I think going further down that path, now the thrift savings plan, you can do in-service Roth conversions. And I was kind of like, yeah, so what, big deal. But it's a big deal, Andy, because what you brought up, but go ahead with that.
Yeah. So that's big news. That's coming out January 1st, 2026. This is for our, mostly for our military folks who are listening to have the TSP. You can do an in-service Roth conversion, just like you said. And that's been pretty table stakes for most 401ks for a long time. TSP, shocker, is a little bit behind the power curve. Where I think that's super helpful is folks who have, you did a deployment and you were making contributions before that the Roth option was available, right? And now that portion is after tax, but it's in that pre-tax bucket, if you will. Well, all those earnings are going to be taxable. And so the only way to fix that problem before January 1st of 2026 was you had to do a rollover, right? And get all those into the different buckets, get that pre-tax into the Roth. So all the earnings growth would stay in the Roth, now in the Roth bucket as opposed to being taxable if it stayed in the pre-tax. The good news is, right, you can roll that or do the in-service Roth conversion. So for someone like me, right, and so or maybe the best example here are military pilots. If you're a reservist, like me, right, you can't you can't do the rollover, right, because TSP won't let you because you're still an active participant. This is an opportunity to make that happen, before you have to wait until you retire at age 42 or what have you. So I think that's a big win. So I'd encourage everyone to take a look at that if you've got TSP with after-tax money in the pre-tax portion.
Yeah.
And yeah, exactly.
Is it safe to say, sorry to interrupt you there, but is tax exempt a safe way to say that is versus pre-tax? Is that similar?
After tax? Yeah, I think tax exempt is after tax. Yeah. Yeah, you've got after-tax money in the pre-tax portion.
Yeah, there you go.
Of the TSP.
And because the really important thing here to drive home, and forget about the after-tax, all this nomenclature that we're using, although that is important. But what happens is that part that goes in after tax, the growth is taxable. So when you pull it out, the growth that you had on all those years on that after-tax money that they put in for you while you were in a combat zone will be taxable. And that's where it's a problem. And you may have mentioned that, but I just want to clarify. That's the problem.
Yeah.
Got to get that out of there if possible. Now there's a way, even like you said, if you're active reservist like you are, or some of our folks that are long gone, retired.
Sure.
It is a pain in the butt to get that out of there. You know what I mean? That's what kind of we've seen. Maybe that's lazy for me to say that, but it's like, I got this chunk of $10,000 of after-tax monies that was put in years ago, and the growth is going to be taxed, and I want to get that growth into Roth so it's not taxed.
Yes.
Either. So But anyway, so hopefully that's helpful as well.
Yep. Yeah, and anytime you're doing in-service Roth conversions or anything with the 401k, I always encourage you just call, because they can tell you the tax implications, because there will typically be, even if you're like, I just want to convert the after-tax portion, the earnings on that is likely taxable, right? So there might be a taxable component to this. So you always want to just call and clarify and make sure that that's you understand those kind of tax implications and if it still makes sense for you.
Perfect. Yeah, that's good. That's a really good disclaimer, because you don't want to get somebody who doesn't want to get a nasty tax surprise because they're trying to do the right thing. So be careful of that. So
you accidentally convert the entire pre-tax balance.
And then I call you.
Here's your $100,000
tax bill.
Yeah. Yeah.
That would be painful. And sometimes some of these things, Andy, they roll out, the new law, rule, regulation rolls out, and we don't know how they're going to implement it. We don't
Yeah.
know what that looks like on the, administrative side of the thrift savings plan. So
Yeah.
we don't know that part yet. Just like somebody said.
We'll do an update. I'm planning to call January 2nd.
There we go.
I'll let you guys know how it goes.
Report back to us.
Yeah.
Awesome.
Yeah.
So Andy, thanks for those two things. Those are again a couple of those help clarify some things as far as the Roth catch up and that little nuanced approach as far as the tax exempt or after tax monies from the combat zone, and that's nice to have that opportunity to convert to Roth in 2026. So now let's shift gears a little bit, because lately we've got a few questions and things about, hey, I'm going to imitate some folks a little bit, but hey, our wealth is getting larger. We've saved a lot. We're saving everything we have in the 401k, IRAs, and maybe a taxable brokerage account that invests in stocks and bonds on the markets. So some people they kind of get a little concerned, like, hey, I am too concentrated in the public stock or bond. I'll throw bond markets in there too. Everything I have is in that. I don't have anything else. I own one home and everything else is in the markets. Should I be concerned with that? And what are my alternatives? And what you're going to take us through today are they good alternatives? Is this a legitimate concern or not? I think those are the questions that I would have too. But that's one version of the question. The other version is, hey, I'm getting wealthier in my airline or a professional pilot career. Do I need to find more sophisticated, complex investments to make sure I'm properly, again, kind of overlaps with the first one a little bit, to make sure I'm properly diversified? Hey, wealthy people, 100 millionaire, ultra high net worth people are doing this thing. Should we be doing that too? Is it available to us? So those are the things we'll be kind of thinking about. Hopefully I framed that well today.
I think it's perfect.
Right.
Yeah, perfect. And I know we've talked about private equity on the show, or you guys have in the past. Always good. It's been in the news a lot, right? And so trying to give access to the private market, specifically within 401ks, right? And for, whatever that wrapper is going to look like, or that investment vehicle is going to look like, that's going to be really interesting to watch and see how that unfolds. I think some of this, though, is what is the investable universe, right? What do I have available to invest in as someone who maybe just looks at the public equity market? And I think a lot of the other comments we hear, Charlie, is, well, there's a lot fewer publicly traded companies out there. And does that mean that I have a lower expected return, or does it mean investing in the public market, right, via the S&P 500 or a total global equity allocation? Does that mean that that's a worse investment today than it was 20, 30 years ago when there were twice as many publicly listed companies? And so that's a fun topic we can talk about.
It is, yeah.
Today,
you brought that up.
well.
I didn't even know that was a thing as far as the companies being reduced on the publicly traded markets. But as you'll show us and talk to, it's similar. I think market capital might be the way to say that. But
that's right.
But one of the things I'll add into this framing before we jump into the nitty gritty is that, and this is a guess, I'm going to go out on a limb and guess that if I have hundreds of millions of dollars to invest, and I go to someone that's a professional money manager, and I say, hey, I have hundreds of millions, there's some other things I want to invest in outside the stock market. Well, I believe that person is going to tell me whatever the heck I want to hear, and so I'm not sure, in other words, depending on what I'm selling you, Andy, I don't care what your problem or your challenge is. You're going to, your challenge is going to fit what I'm selling or what benefits me as well. So I think there's a little bit of that going on. People might say I'm naive or whatever, but I do believe, I'll just confess right off the start, I believe you can be really, really wealthy and just invest in the public stock markets. Now, you don't have to. There are other alternatives. You're going to talk about those today. But Andy, I'll stop my bloviating because I got on my soapbox a little bit. But can you just kind of lay this foundation for us a little bit for those that didn't hear our last podcast? I think it was Flight 113. Check that out too. It's a little bit more. Me and Kevin did that one, a little bit more skewed to the 401k, new rule, et cetera.
Sure.
But what is private equity? Can you kind of just lay that out for us?
Yeah. First, I'll jump on your soapbox that you got off. I'm with you, Charlie, right? And I think every financial product out there is an ideal person that will benefit for the most part. The problem in this industry is it's a lot of sales driven.
Mhm.
And so you're incentivized to not just find the ideal person for this product, but to make everyone fit into this product because that's how a lot of times you get compensated. And so I think that's the challenge of this industry is parsing through that, right? Like, Yale, these endowments, yeah, like the private equity is great for them, right? Because in perpetuity, right? These funds are going to last forever. They don't need to access them. That's maybe changed a little bit in the last year or so. But like that's the ideal person, right? If you're this $100 million family and you've got a private foundation, like private equity, so but we want to sell to evereverybody, not we, but the financial services industry, I think, can sometimes fall in that
And
trap.
I recognize our biases too, because people will say, well, of course, you run a registered investment advisory firm that invests in the stock, that you put clients in stock market. And so I am biased for sure.
Yeah.
All right, Andy, what is
What was I going to
private
talk
equity?
about? Yeah. Yeah. Well, I think first of all, like what is the public market, right? Like how does that work? Why does that matter? And so I think what's important to think about here is, how do you become public? Well, you have an initial public offering, an IPO. And so then you trade just like a stock on the market and anyone can access it, right? We all know Robinhood. I can go on Robinhood and I can go purchase this share of Google or Amazon or Apple. And so that's the publicly traded market. Typically, that's a mature company. You go public because you want that financing. It's a very efficient way to get capital, and then you get access to the debt market. But what is private equity? Right, just as it implies, it's private. So this is a company that is going to buy a portion or maybe all of these, or a firm, right? It buys all these companies, and their goal is, of course, to turn it around in 7 to 10 years and make money off of that deal. They typically use a lot of leverage, meaning they take on debt, right? So they take out these loans to help go purchase this company, and then their goal is to turn it around, make it more efficient, and then sell it, or maybe they IPO that firm, that company down the road. But that's kind of the deal, right? So when you're private equity, it's like, well, how do you have money? You've got these general partners, that's the people who run the company. And then you've got limited partners. Those are the people who give the money to the GPs to go out and purchase these companies. So that's the challenge, right, of private equity is it's typically only for accredited investors. You got to have a lot of money. They're going to want to draw down, right, committed capital, right? So they say, I want $10 million. And they're going to, over a series of years, they're going to say, I need $1 million. I need, $500,000 because we want to go invest in this company on this fund and do that. So I think, Charlie, like some of the reasons why we'd like private equity or people find it enticing as well. Those are market opportunities out there. Those are ways to go access different markets. Maybe there's higher returns, and some insights that those fund managers might have that, we don't have on the public market as investors.
There's a lot to it. And I thought it was fascinating earlier when we talked, about why would a company not want to go public? And then, some of those things and as far as how do I pick these private companies, if private equity, if I'm going to do that. But first of all, why do people want to stay private, perhaps?
Yeah, it's a good question. Right? We've seen, if people heard of unicorns, right? These are the companies that have $1 billion valuation. Right? SpaceX is, I think, $350 billion private company, and so we have a lot more quote unquote unicorns in the market now, which implies that those companies that would have maybe gone public sooner didn't. They decided to stay in the private marketplace. And so maybe a lot of reasons. One, it is more burdensome, right, to be a publicly traded company, right? You've got to make quarterly disclosures. You got to do earnings reports. You need to do shareholder, right, engagement. And so, there's some component to that. I think just there's a lot more money in the private space now as well. There's a lot more kind of dry powder, if you will, and venture capital and private equity. And then some of it's just the types of companies, right? These are like technology firms, AI firms, right? And so it just doesn't require as much intensive capital to run these companies that would maybe require an IPO and access to the public equity and, public markets.
Yeah. And, earlier you mentioned, and I just wanted you to elaborate a little bit. You talked about this idea that a Yale endowment can do these things, or any endowments, if you will, because they have this time horizon of perpetuity. But what what difference does that make as far as why does that affect them and not me?
Yeah, because a lot of times if you're in a private fund, you're locked up, right? If you commit this X number of dollars, number one, you've got to make when the capital calls happen, you've got to make those commitments, but you can't just say, oh, I want to sell, right? I don't want to, I need cash, right? I'm going to sell my shares that
I'm
I
going to
own
retire.
of this.
Yeah, I'm
I'm
going to
going to
retire.
retire, right? And so if I own Google or I own a share or 10 shares of Amazon, I can sell that like that, right? Like right now. And I can, whatever it's worth, I get, and on Schwab, right? Or whatever brokerage, online brokerage. You can do it on your phone. You can't do that in private equity or venture capital if you're a limited partner or investor in these firms, right? You've got to wait for them to have the capital to redistribute. And there's all sorts of, math in terms of who gets what when, right? Because the general partners, they're going to want to get their cut as well. But you've got to wait for them to distribute that capital back. Well, how does that happen in a venture capital or private equity? Well, they've got to make a return. Well, they've got to sell the company or they have to IPO that company. That's how the money comes back for the most part, right? There's some more nuance there. So you've got to wait. And so that's where it gets in. Like this is 7 to 10 year time horizon to get that cash back. So back to like if you're me and you, right? If I'm a retiree, that's not so great. If you're in this downturn and you're like, oh shoot, I need money to pay to put food on the table. But if you're the Yale endowment and you're only paying out 4% of your net income for the year to finance operations, and you've got this indefinite time horizon, like that probably works out, or you're this private foundation or nonprofit or whatever endowment.
Yeah.
That might work out well, okay for you. And so that's the difference.
I think that's called the illiquidity premium. I mean, I think investors expect a somewhat higher return because my money is locked up for years. You don't even know. And I think the best example of this, Andy, is the book, The Big Short. That was one of the best examples. I think in the early 2000s, I remember from the book, they were shorting the mortgage industry. They knew what was coming, and people piled money into them. But several years later, it hadn't happened yet. We're talking 2003, now 2004. It hadn't happened. All the investors, and there's a scene in the movie and in the book, if you read that, where they're demanding their money back. And the hedge fund or whoever he was, I can't remember, PE guy, says, no, you can't. You can't have your money back. And it was about to go out. It was about to be gone, disappear. You cannot get your money back in some of those circumstances. So that was very clear, great example in that book and movie.
Yes. Yeah. There's a lot of funny things going on now because we just haven't had the exits, right? In terms of how these funds are returning money to their investors to make that happen. But sign of the times.
So look back to it's just you and I. Let's say we've got enough money. We've got the money, man. We're going to go private equity. What are the challenges on like the mechanics? Because you and I were talking in pre-show, like, hey, I can go buy the 500 largest companies in the U.S. and I can get the average representative return of those companies through that index. But let's say I go to the private equity world. It's a little different, right? I think you were kind of educating me on, well, I got to pick a company possibly. And now I'm back to this actively guessing who might be successful and who may not be. And it's extreme volatility on that side too.
Yeah, that's a great point. So I can go and I can buy effectively every publicly traded company in an ETF or a mutual fund today. And then I get the average of that return, right? Within that dispersion, there's some companies that, do incredibly well and some that don't do well, right? Have very negative returns. But I get the average because I own all of it, right? I own the entire market. I can't do that, right? Back to our, like, how are these funds structured in private equity or venture capital? Well, I can't really do that because the capital required to invest in the entire universe is such that, like, I don't even know the number, a lot of money to make that happen that I don't have available, or most people don't have available. And so now the problem is, there are companies that, venture capital firms, right? There's private equity that have done very, very well, and they've invested and had great returns. I just have to know who they are in advance, right? And that's the same problem with active management in the public markets, right? I have to know who the best manager is in advance. And now it becomes super challenging. So I don't have access to the average private equity return. I have access to maybe one or two private equity managers. And then I just have to hope that they're the ones who are going to have these outsized returns or give me an adequate level of return. And that's a much more challenging investment thesis, I think, just because that maybe someday in the future we'll have this ETF that's the private equity ETF that truly gives you that full exposure. And I'm all in, but we don't have that yet.
Yeah, absolutely. Yeah, it's interesting that we as a firm, we just read the book about the creator of Zappos, I think Delivering
Yeah.
Happiness or something like that. But they, in between some of his, before he started Zappos, they were essentially buying companies. They were acting as a private equity, I believe. And it turned out that all of their companies lost, I think they lost money on every single company except Zappos. And so it was
Yeah.
this amazing, you hit it huge or you lose really badly. You know what I mean? It seemed like this in that
Totally.
scenario anyway. I know it's maybe not always that way, but to your point, you got to make you got to make the right guess. And I say guess intentionally because you don't know the future. And like you said,
Yeah.
now we're back at this idea of like, well, it's very difficult to invest smartly in that world.
Totally. Yeah.
Mhm.
Totally.
All right, let's see here. So that's kind of the challenges as far as how this looks as far, should we invest outside private equity? We talked about a little bit. There's other things too, like private real estate, oil and gas, and some of those work for people, and we talked, I think Kevin and I talked in our other podcast about, hey, what's your balance sheet look like? Are you living on the edges? Do you have, the right amount of money in taxable brokerage accounts? And can you afford to even take this risk in the first place? And I think that's the big one, is that most of the time people say, I want to go private equity, I want to do private real estate. And then the balance sheet, personal balance sheet may not be that strong to begin with. It's like, well, there's a lot of risk here. And so maybe we shouldn't take this risk if we're not ready and the balance sheet, doesn't support it, because it's like, as we just said, it's very volatile. But I think one thing you shared with me was the private real estate markets versus the public. And to me, I was just kind of like I mentioned earlier, hey, if I'm doing a private investment, I got a liquidity, I deserve a premium for that. And it looks like in the public real estate market, that may not be the case. Is that kind of what you were talking about earlier?
Yeah, I think so. I mean, maybe before we go there, let's chat what is out there from what's publicly available companies, right? Because I think I've heard quite a bit of, hey, the stock market is X number of companies, and now there are fewer investment opportunities in the public market. And so to me, it's like that means someone is like, oh, that means I need to go into into private equity because I have fewer investment opportunities on the public side, right? And so it's just kind of, I think it's just, if nothing else, it's interesting to think about. Maybe isn't the case, right? And so if a good paper came out of Dartmouth, you have the February 25 Journal of Financial and Quantitative Analysis, Espen Ekbo and Marcus Liffel. So I think I need to give them their due here. But they said, okay, so back in 1996, there were 6,000 companies publicly traded. In 2020, it was a little under 4,000. So you're like, oh, I have 2,000 less companies. But when you look at some of like the merger M&A activity, it's actually been pretty consistent between the two, right? In other words, the amount of publicly traded, I would say, available value has remained constant over the last 30 some years. So I think that's kind of cool just to think about and talk about of, there really is no difference in the public markets today than there was back in, the peak of 1996 when there were all these IPOs.
Yeah.
And so to me, it's like, I can still get a good investment in the public equity landscape.
Absolutely. Yeah. Another one, Andy, that we hear is, well, public markets right now, stock markets are all-time highs.
Sure.
So I think the follow-on question might be, what do we do? Do we take our money out? What do we do? Do we invest maybe in something different? But that's a normal thing, right? As far as, all-time highs, it's kind of to be expected, right?
Yeah, I mean, it's like the market is kind of always going up, right? And so we're kind of always in this perpetual all-time high with, there's going to be some downturns, right? Of course, we know that, but we don't know when, and we can't time that, but we're always at all-time highs,
Yeah. So copy,
if
you
you
said
will.
the market always goes up. Thank you for that.
Oh, yeah, there you go. You nailed it.
Absolutely. But yeah, it's over what 100 years it has, right? And
Yeah,
that's the point you're making is that, well, we've always had all-time highs. And it is a little nerve-wracking when people think, oh, the market's overvalued, maybe, we're gonna have a pullback. And that's kind of it's a natural feeling of like, man, am I investing in here and I'm going to get shellacked, because the market's going to correct? Well, maybe,
yeah,
but if history is our guide, then it would be a temporary situation, to your point, in that. And there's also been several years. In fact, we just had one, maybe 2, 3 years where the market was flat. And I think it was the
hmm
fall of 21 and finally started surpass that amount. And it may have been 24, Andy, early. I can't remember, but it was a long
yeah,
time where people are like, hey, I'm putting all my money in the market and it's my dollar value is going down. And that's not unusual. That's not unusual at all. So yeah, the market over history has gone up over time, but yeah, you're right. And it could be there'll be some tough periods there too. So not a reason though to go outside the markets for that reason alone. There may be some other reasons, but I thought that was
totally.
interesting as well.
Yeah. Back to private real estate.
Excellent. So so Andy, as far as the private markets are concerned, it's interesting to look at the different returns, how we might do that. Are they appropriate? We've talked about, what are the private equity markets? What are they made up of? Who might, benefit or who might consider it? Nobody has to consider it, as far as I'm concerned. We talked about you could have hundreds of millions in wealth and not go to the private markets if you don't want to. You've talked about some of those things, but let's talk about the performance as far as, like we mentioned earlier. Hey, if I've got money locked up in a private equity fund, the investor expects what's called an illiquidity premium. Private equity is out, private real estate is out there. I can go invest in real estate that's a lot of buildings in Manhattan, and you could go buy
hmm
parts of all those buildings, and you could be a real estate owner. And does that do better than the public markets? Is probably the question people are thinking about too.
Yeah, I think if you look at private equity performance, and now I'm gonna give a shout out to DFA here. So they did a paper, Understanding Private Fund Performance, which was a really good read because the takeaway was, yeah, like private equity has outperformed certain segments of the market, right? It depends on what it is, right? So if you're a buyout, which is leveraged buyout, private equity, the average has outperformed or has provided pretty good returns, right? They all have venture capital, private credit, private real estate, and so to me that says like, yeah, there's opportunities out there. Clearly, there wouldn't be private equity firms if everyone lost money every time they did it, right? So IRR, which is internal rate of return, that's sometimes a good way to talk about it. It gives a nice number that people are used to, right? So the average on like private equity buyout, right, 11.6%. Okay, that's pretty good. If I could get access to that, I would take that all day long. Private real estate, 6.49, 6.55% average IRR or return. So again, like I would take those returns. So back to the point, we were talking about earlier, Charlie, is you've got to have the average to get the average. Otherwise, you got to pick the winner or know who's gonna outperform
So in
the
other words,
market, which is super challenging.
yeah, sorry to interrupt you there. So in other words,
Yeah,
I can report these average returns. Again, this is kind of just reiterating what we talked earlier. I can report these average returns of 11, 12, 13, 14, but I can't just all of
yeah,
a sudden go, I want to invest in that. Because
that's
to your
right.
point, it's not set up that way. I got to go pick a company or two, I guess, depending on how much money you have, and
Yeah,
then you hope you get, above average. I would hope, but I might
that's
get well
right.
below.
Yeah,
So anyway,
yeah,
that's the interesting piece. I didn't think about that beforehand.
that's right. Yeah, and we can get a little more technical. Even they can compare the returns on these private equity venture capital to a public benchmark. So in other words, it's what's called the Kaplan-Shore public market equivalent, which is super interesting, right? So you take essentially the value of the distributions divided by what you contributed, right? So you hope you have more distributions than contributions. And if you discount that to the present using the returns of, say, the S&P 500, that would, if that number is greater than one, that would give you a good indication of, did this outperform, say, the S&P 500, or they looked at large cap value or small cap, right? And so to me, it was interesting to see is that they on the average, right? It did, right? But private equity venture capital outperformed the S&P 500, right? Which is pretty cool. The only thing that didn't, right, that did better on the public side was small cap value. Small growth was about equivalent. So I guess one way you could look at this, Charlie, is, hey, I want to have access to private equity venture capital. We'll just allocate part of your portfolio to small caps, and then that becomes your slug there, right? I don't know. Yeah. As a way to think about it. So again, this isn't to say, right, I think it's easy for me and you, right? We invest in the public markets. That's our portfolio. We want to say private equity has not done that great. No, it's done good, right? And it's a good investment.
Yeah.
If you know where to look, right? So that's the challenge. But to your point, the one that didn't outperform any category was real estate, right? So private real estate underperformed REITs by a pretty sizable amount, and just the real estate industry in general. So if you were to look at just this paper, right, and this is not investment advice, if you were just to look at the outcome of this paper and say, I would never want to own private real estate because I could just access a better return historically using like a REIT, right, a real estate investment trust that's publicly traded, daily liquidity, always liquid.
Yeah, yeah, and that's I love your comparison to small cap, because small cap is, over a long term, I don't know what period, probably 80 years plus, has been a big winner. But man, it is hard to stay invested in small cap sometimes. And I think that would be a very similar feeling to private equity, where, maybe, and that's why if you've got an investment time horizon infinite, like some of the endowment funds, then whatever, I've got infinite time. Yeah. But man, I'll just tell you, from my perspective, we use small companies and they're successful, but it takes a lot of discipline to stick in those investments, causes bad investor behavior because they're down more sometimes than others. And of course, obviously they're up more too. That's why they have a pretty good long-term return. But I think that's a great little illustration of what it might be like to be invested in some of these things, where you probably are going to want to really get out at some point because they're so volatile. Volatility is really hard, but anyway, I just, not for everybody for sure.
Yeah. Great point. Great point.
Awesome. All right, Andy, as we wrap up here, any parting shots or anything we didn't get to cover as far as the private equity? And when I say private equity, I think I'm probably leaving out some other categories, leverage buyouts. I don't know if that's all the same type, but I think people understand what we're getting at. But Andy, thanks for, kind of breaking these down and giving us the background. It is fascinating. I think a lot of times people will seek out other investments outside the markets because they need more diversification. I think you showed us today that there's thousands of companies all over the world. That's quite a bit of diversification. History is kind of on the side of the public markets as well. There is a place for private equity, maybe, for some folks, and some of our folks we know have done that: oil and gas, private real estate, whatever it might be. But I think too, people can do really well with public markets, and even though I am biased, but nonetheless, So it's sometimes I think we seek out complexity because we feel like we're supposed to, and I think that's a natural disposition of us. The way we're wired is to seek complexity because it makes us feel like we're doing something really, really good. But in the world of investing, I think that the opposite is probably true, to seek out simplicity. Just be careful, I think, as people explore other things out there. Complexity is not always the answer, and it's our natural inclination to do that. Sometimes it gets us in trouble as well. So those are my parting shots, Andy. But what about you?
Yeah, I think the takeaway parting shot for me is the public markets remain robust. They continue to provide value and have this, the same level of economic value as they did, over the last 30 plus years. So I have faith in the public markets that this is still a good investment, even though net on net we have fewer companies, right? And then, Public equity returns, it can be quite lucrative, just like finding the one publicly traded company that's going to have this crazy performance is just as lucrative, but you've got to know where to look. And until I can invest in a broad basket of private equity at a reasonable cost with liquidity, to me, I still like the public markets because I know that and I can get in and out of that. No problem. So there's kind of value on both sides of that coin.
Yeah, well said. A broad sample of private equity, low cost with liquidity. I think those are huge points that you don't get otherwise, and that's a big deal. So, Andy, thanks so much, man. We appreciate you digging into the nuts and bolts, into the weeds of the private markets, private equity, so we can learn more about that and pass it on. But please, again, thank you all for listening. Share and rate and review the podcast. We really appreciate it. Reach out to us anytime if you have any other questions. It's going to be Andrew at leadingedgeplanning.com or Charlie at leadingedgeplanning.com. We'd love to field any questions, comments you have. And so thanks so much. We'll see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.